Another episode of the Capital Gains Tax Solutions podcast, where we believe that most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to exit your highly appreciated assets tax deferred so you can create and preserve more wealth. I'm your co-host, Pearson York, filling in for Brett Swarts. In each episode, I'm joined by some of the best wealth, business, real estate, and leadership individuals in the world to share ideas, deal stories, and inspiration so together we can make complex tax deferral strategies simple and passive income plans achievable. As always, we're streaming on expertcresecrets.com, Capital Gains Tax Solutions YouTube channel, the Facebook channels, Kingdom Luxury Realty YouTube channel, and the Kingdom Luxury Realty Facebook channel. Our next guest has actually been on the show fairly recently, but we brought him back to talk a little bit about the paradigm shift in the market. He's a managing partner over at Goodstein Wealth, and please give a warm welcome back to Matthew Murawski. Matt, how you doing, bud?
Hey, Pearson. Good to be back with you, man. Let's talk about some fun stuff. A lot's happened since we last spoke.
Yeah, absolutely. So just so people who have never tuned in, can you give a brief 1 to 2 minute just backstory on you so we can get people caught up to speed if they missed the first one?
Yeah, absolutely. So I started way back right before the financial crisis in 08 at a VC firm up in the Bay Area. Was there a few years, and I loved the markets, loved everything about it. Everything's new every day, but it wasn't the space for me. So when I moved to LA, I met my partner now, it's Alan Goodstein, and we have a RIA, a fee-only RIA here in Los Angeles. I'm in Century City, and he told me when I first started with him back in 2012. So if you do right by the client, you'll have a very successful business, because a lot of people don't do that. And so it's a very simple approach to things. Be transparent, but we help people manage their assets. As far as we're fee only, we're fiduciaries on every account, and we're really there. We have clients that really just want us to manage their assets for them and speak with us 30 minutes a year. And I've got people that we're working on complex financial plans that are a lot more intricate, whether or not they're selling a business, trying to defer their tax, or whatever it is, just get set for that next generation, because we're starting to see that turnover in generational wealth to the next generation, because the baby boomers are in their mid 60s to 70s now, mid 70s, like my parents, and you're starting to see that shift. So it's a little bit on us. We're here in LA and enjoying the sunshine.
Yeah, awesome. And typically, if you guys have been listening to this podcast for any length of time, kind of the flow. I'll ask about the strengths or spiritual gifts, but we've actually already done that. And so if you want, you can go back and listen to that episode, and we'll put a link down in the description below when we launch this one. So I'm going to kind of skip that, and I want to get right into what we were kind of talking about, because I think that everybody is very curious about when is the next crash happening, right? When is everything going to come tumbling down? And I think that a lot of people are equating, kind of just wanting this 2008-esque type of thing to come back, because the people who had money made a lot of money buying up super deeply discounted, stocks and real estate and whatever, and they're thinking it might come back. But we were talking before a little bit before the show about this paradigm shift that's starting to happen. So Matt, tell us a little bit about kind of what you're seeing and about this paradigm shift that you're starting to see in the market a little bit.
Sure. So, when the pandemic hit, it was, as far as the market goes, it was all about story stocks. I mean, you could take, that's why there was this big rush to put everything in a SPAC. I mean, all these electric vehicle companies that haven't even sold a single vehicle with, billion-dollar valuations that were just insane. And you've seen the catastrophe of that. Even some stocks that I like, that I think are going to be great companies and going to do well over the next 5-10 years, that happened to go public during that time. But there was if you had a good story in 2020, 2021, early part of 21, you could go public and do really, really well. And a lot of them did, especially in the EV space. But now what you're seeing, and just in the last 24 hours, I mean, Netflix was almost a $700 stock over a year ago, peaked, and now is trying to hold water at about $200 a share. And so you've seen these high valuations. What's happening is a lot of the interest rates. If you listen to the news, they'll say that the interest rates hikes are priced into today's stock market prices, and that's really tough to believe. I think some of it is, but and my wife just asked me this morning, she goes, "I don't understand what the deal was with the interest rates." I said, "Well, essentially, it's this: when the Fed says that they're going to hike rates, so they're going to up the cost of borrowing." It affects, Pearson in the real estate industry, those buyers that are right on the fringe that could just afford it. It kicks them out, because when that rate point goes up, we're supposed to see a half a point raise in May, and another one, a couple back to back. And so what it does is it creates the cost of borrowing capital, of funding new growth. It makes it a lot more expensive, and a lot of times it makes it not feasible. So in essence, it slows growth. And that's what the Feds wanted to do, because we've got this huge inflation problem where there's very little supply and there's so much demand for it. There's a lot of money floating around the system, and the U.S. consumer, which is 70% of our economy, is really healthy right now. So they're doing what they can to slow down inflation, but with that, by hiking interest rates, which is a good thing, and it means the economy is healthy, you're going to see look at companies like Peloton that fell off a cliff. You've got anything with a high valuation, the Zooms, DocuSigns, Teladocs, those companies, the ARK funds. If you follow the ARK funds, my God, they were $150. They've been at least cut in half, or more, depending on when you got in. And so anything now that you're seeing that creates current cash flow, look at energy stocks. Look at the boring companies that just create free generative cash flow. Those have been the shift. That's where the puck has gone to. The dangerous part is when you try to go from here to there, and you usually miss the curve, because at some point it flips the other way, and you never know when the market's going to flip.
Right.
So there's been the rate hikes for sure. Are going to put increasing pressure on those high valuation stocks that don't necessarily have earnings this year or next year.
Yeah, absolutely. And so, it sounds like what happened is back in when the pandemic hit, there was just an influx of cash that was just created, and there was a bunch of probably relatively young and unsophisticated investors. We call them the retail investor, right? On Robinhood and Webull, who were just throwing money into stocks like AMC and GameStop and Dogecoin, and making a ton of money when it was, squeezing and skyrocketing and all these things. But now the Warren Buffetts of the world are starting to kind of like recapitalize, because they were buying you know, all their stocks at super deeply discounted when everything was low, and just kind of waited it out. And now it's shifted and it's going back into their favor. Is that a fair summary?
That's about as clear as you can be. I mean, the thing is, these things shift back and forth. That's why the really boring old adage of being diversified and knowing risk tolerance and knowing those basic things that we've always heard come into play, because you can own pieces of the different buckets. You can own the high growth, you can own the boring, you can own the energy, you can do all those things. But when you try to flip a switch, like if you listen to CNBC or any of these other financial news, these guys they'll recommend something one day and they'll flip the switch. You don't know if they sold it the next day or they're shorting it the next day. And so for most average investors, you can't get caught in this. It's like, the 90s mom jeans that just came back in style that I think are horrendous. Those, right?
Yeah.
Here in LA, everybody out, I'm in Century City. I walk home, and every new cool kid, every new cool, trendy female is out in these mom jeans. They look terrible in the 90s. They look terrible today. And it's like, if you go and switch out all your old jeans, eventually that fad's going to go away. And investing is similar. Like, you can't get caught up in the new mom jean fad. because it whipsaws on you, and you get cut off at the knees real quick.
So I want to bring this around to a more philosophical kind of question. So you mentioned that diversification is kind of the old adage is the best way to mitigate your risk. So someone who had invested a significant portion of their funds, whatever, a good amount into some of these narrative stocks, right? These story stocks, meme stocks, whatever the case is, right? And they made a lot of money. How can they exit that and then get into a more diversified portfolio without feeling the tax implications?
Sure. So, I mean, it depends on where they bought them, right? So, if you're buying them in an IRA, or if your 401k happens to be one of the rare 401ks that offers what's called a brokerage window, which
Mm-hmm.
most don't, but a few do, there is no taxable, there is no 1099 for this year. If you're in a tax deferred account, then you don't have any mean to worry, because you're going to pay taxes when you take the money out, right? Unless you're taking withdrawals. So depends on what kind of account. Now, if you're in an individual account or a trust account, what many people know as a regular brokerage account, there's two ways. I mean, you guys talk about the deferred sales trust, but also before you even get to that, the years prior, if you're brand new, it's tough. But what you do is you want a tax loss harvest
Mm-hmm.
each year, and that's where, let's say you bought ABC company and 100, now it's at 50. You do get some credit for short term, but really you want to have held the position over 12 months, and to offset gains. Like, let's say you bought Tesla at 500, and now I think it's floating around 1,000, and you've got gain, a 50%, or 100% gain there. Uh, you would be offsetting taxes by doing what's called tax loss harvesting. You have to be very smart about it, because not just because something's down at a loss doesn't mean that you want to sell it.
Right.
There's certain positions that I have as that are losses, that are great companies. There's just what the market's doing, what the market's saying right now. So you don't need to sell everything that's at a loss, but it's most beneficial if you can find positions that are you've owned for more than a year, and you can use that tax loss carried forward indefinitely. So over your investing career in your individual accounts, the first action, the lowest hanging fruit, best way to do it is to tax loss harvest, because at some point you're going to buy, whether even if you're just buying indexes, at some point the large cap growth is going to be negative and the value is going to be positive, or the small cap is going to be negative and the mid caps are going to be positive. So you got to be selective, and you have to wait at least 30 days to buy back that position, right? So tax loss harvesting is an extremely important aspect of investing, and I don't think many people really understand how to utilize it
Yeah.
properly, because it doesn't mean that anything's at a loss, you just sell it, because there's just certain things. But let's say you own a stock that was at 60. I won't name names because we can't be a compliance, and let's say it's trading at 16, and it doesn't, the next year, 2 years doesn't look too great. um, that's something you might want to, and you've owned it for over 12 months, that's something you might want to sell, might want to look at, taking that, because you'll get that tax loss carried forward against your gains and whatever you were
Right.
buying. You had these huge, but that takes time, that takes years to compile a meaningful, and hopefully the name of the game isn't losing money and accumulating
Of
tax
course.
loss harvesting. The name of the game is, really smart guy told me this 15, 16. He goes, your objective is to owe as much tax liability as possible, no matter what field you're in. Your objective is to owe as much tax as possible. Here's the difference. You want to find out ways to pay the least tax possible, because if you owe the most tax, that means you made a lot of money, right?
Right.
You want to create a huge tax liability, and that's not popular to say, but that means you've made a ton of money. That is the only, and then the second part of that, the more important part, is you want to do the most you can do to legally, obviously,
Of course.
defer or mitigate those taxes. But you want to create the biggest tax mountain you could ever think of, because that means you made an insane amount of money. And then there's strategies that you guys talk about, as well as tax loss harvesting, which are extremely important to mitigate and do what you can within the realms of what's legal to pay as little tax as possible as what's in the book. So um,
Yeah,
yeah,
absolutely. So if someone were to, just given kind of like the current shift in the market, right? If someone were to really be interested in protecting their downside and they have, let's just say they have, a $10 million asset that they've completely depreciated and they're selling this piece of real estate and they have a $3 to $4 million capital gains tax. But they're able to use the deferred sales trust. And with the deferred sales trust, you're able to sell real estate and go into stocks and bonds and mutual funds and all that kind of thing. Where would you kind of recommend that they put those funds in order to protect their downside the best in this market?
sure. I mean that's a one that the I call it the DST. I don't know if you guys use that term. I
Yeah,
might not, but
different sales trust. Yeah,
yeah, but that's a fantastic way because as you know, the 1031 exchange just puts the real estate to real estate. So let's say there
of course.
wasn't like right now, it's really tough to find. I mean, real estate that's at a reasonable price. I mean, I had a client just sell. It got an inheritance. It was an aunt's home that was like a $600,000. They were hoping that they would have been happy to get 600K. It's in the valley here. It's a
Mhm.
small little house, and they had 20 plus offers on it, and it went for 150,000 over
Yeah,
asking, over what
yeah,
would have been a great price for it because it's a dump. It's
yeah.
it,
It's what, like a 2-1 900 square foot place, like just
exactly
going for
it,
750 in the middle of the
in
valley.
the
Yeah,
midst of Van Nuys, like no. Um, but so it's like the real estate market's really tough right now. So if you were using the DST to go into stocks, man, I mean, you have to know your timeline. So whoever
right.
that client is, it's not there's no right answer. Here's what's going to win the next 6 to 12 months because nobody knows that.
Of course.
Um, but if you've got 5 years, you
Mhm.
know, we're gonna see a cycle, I would imagine, or two within the next because you and I are young enough. We really haven't lived through bonds have been and have been in a 40-year bear market. They've just been sliding down.
Right.
I'm 36. I know we're roughly about the same age. You and I have not been through a market that where we've seen, other than 2018, really, where we saw a 20% crash because they hiked rates real quick 4 times. But we haven't been in a market where we've seen rates where they're talking about 8 to 9 rate hikes this year.
That's crazy.
That's like, what are we going to have? That's in. First of all, it's a joke. That's insane because the cost
Yeah.
of the United States, our country's debt, the government debt, just servicing it is impossible. But also, I think they're just trying to scare everybody because it just doesn't make any sense. Rates do need to go up, but that much I mean, who's going to be able to afford? What they do, we have trouble right now because we have a lack of supply and a huge demand. So one way to curb that is to put rates up. But where to put money in the market, not to get away from your question, is it depends all depends on the timeline. Like I said,
Right.
there's companies that have recently gone public that I really like that I can't buy right now because you look at a chart on them and they're just, it's like catching a falling knife, right? um
Mhm.
so I've just recently had a couple new clients sign on, and they've got time horizons of at least 5 to 10 years. So I can tell you, for someone like that, that's investing for at least 5 to 10 years, I'm adopting a strategy of dollar cost averaging in, little by little, because
Of course.
I know that I've seen more wealth destruction by trying to wait and time the market because everybody always thinks that the market's going to crash. And eventually they will eventually be right because it's just part of the game. It will
Right.
eventually at some point, we'll have a full 20%. We'll have another 40% correction, catastrophe. We'll have another 50% at some point. I don't know when, but I'm adopting I'm cautious because I'm aware enough that I haven't been through one of these cycles. And even my partner, who's 65, he hasn't even really been through one of these cycles.
Yeah.
And not many advisors, unless you're literally like 80, 90 years, or, the Lee Coopermans of the world, have been through this. So to say that we know what's coming, we don't. To say that we know that the rate hikes are priced in, we don't. And so I'm being cautious, putting money into the market on red days, on bloody days, biting my fingernails on the days like yesterday where we're up 400 or 500 points of like, oh, I should have put it more. I should have done. But the reality is, um, getting people to stay in the game is the key, because it's not timing the markets, it's time in the markets. And I think, putting in a whole boatload of money all at once today, like we might have done in 2020 or 2021, is really risky with everything we've got going on, with China, Russia, and then
Right.
interest rates. But so areas of the market that I like, I think energy is probably going to be strong, but I think people have missed the boat on that. I think it's late.
Yep.
Everybody's talking about energy. I really liked energy in 2021, and when it went negative. It's 2 years ago today that energy went negative. Can
Jeez.
you imagine? Oil went negative per barrel. So
Do you imagine?
can you
Like,
imagine?
who bought oil? Like, who got paid for oil like 2 years ago?
It's
They're making buku bucks.
it's crazy. So
It's
you
yeah.
really got to be, diversification for the average investor is key. Now, Warren Buffett is also famously quoted in saying that diversification is essentially garbage, right? Because he
Yeah.
goes in and he buys a whole company, or he buys a big part. Like he buys, he's not buying the S, but it's a whole different game, right? A whole different expertise, risk tolerance, all that kind of stuff. But for the average investor, I'd be tiptoeing in, and days like yesterday where I was kicking myself for not putting more in last week, I'm just, it's that discipline, because I don't want to wake up to a 10 to 15% correction with brand new clients and be like, oh, look, I gave you my net worth, and oh, look, the market just tanked. Because the reality is,
Right.
I think the pent up demand in this market is insane. I think it's there. Here in LA, the amount of people that still haven't gone out and spent money to do things, I think is going to, and across the country, is going to be intense. But I'm very cautious, and tiptoeing into the market. As far as sectors, I think it's really tough. I think oil is probably going to go higher, but I think it's also well played out. It's not something I'd be buying at this point. I think it's late.
Right.
So that's not to avoid the question of where would you put the money, but I think you just gotta, you can buy a little bit of all those buckets as long as your timeline is long enough. So Amazon was a garbage company for 10 years. The stock chart. Look at Amazon the first 10 years. But it's a matter of what are you willing to hold on to for the long term, and those are the companies you buy.
Yeah, absolutely. So it sounds like the strategy is to dollar cost average into a diversified mix of all the stocks. So, because really what the for people who are kind of nearing that retirement age, right, who have accumulated a lot of wealth into like an appreciated real estate asset, or even a plethora of different stocks or whatever, and or business or whatever the case is, right, that have accumulated that wealth there, that need to exit it and to put it into something else that will not just like completely obliterate them. I mean, are you saying that, like, we talked about, I've never seen a bond be any, I would never put anything in a bond. Like, I just have never even for once seen like that to be a viable strategy at all. Like, I feel like the inflation would just eat the money away.
You're
And
exactly right. I mean, inflation's really, I for what it's 10+%. It's over 10% if
easily,
you actually really,
easily.
for the average person. Now, what CPI says is what CPI says, but you and I know inflation's over 10%.
Oh,
Um,
yeah,
and
definitely.
and so yeah, for guys like you and I, we're younger. There is no reason for us to own bonds anytime in the near future. And this is the really scary part for you. You said those retirees that are on fixed income. When interest rates go up, bond prices work inversely. And you know that working in the mortgage market, when rates go up, So when the new bonds come out, and my wife was asked, she's like, I don't understand the bonds, and I'm like, don't worry, nobody really understands. Even the people that talk about it don't understand. But in the most simplistic terms, if you own a bond today that's paying, let's just say it's paying 2% for easy math, rates are going up. So the new bonds coming out are going to be at 2.25, 2.5, 2.75. And if they're talking about 8, 9 bumps, they're going to be a hell of a lot higher than that. Well,
Yeah.
then yes, if you hold your current bond to maturity, if it's a 5, 2, 10-year, whatever it is, you will, as long as they don't, whatever the issuer is, they don't go bankrupt, you will get your money back and you will get paid that amount of interest. But if there's an event where you need cash and you have to get rid of that bond, no one wants that bond for what you paid for it.
Right.
And so it loses value. The scariest place, I mean, the stocks, equities right now worry me. But I think it's also after such a huge, run the last 3 years, it'd be normal to have this kind of choppy market. But the place that actually terrifies me more is the bond market.
Yeah.
Like my retirees that are on fixed income, I have to find other places, or very very short term and treasury, inflation protected bonds, because bonds are all but assured to lose value just because the rates are going up.
Right.
So how, used to the 60/40 portfolio is completely dead. You'll get killed in that. You'll lose. What happens when rates go up another point, percent, or point and a half. Your bond portfolio that you're holding, if you're old, especially the longer duration, so the longer term that bond is, man, those people don't realize you can get killed just as easily in the bond market as you can the stock market.
Yeah.
Besides, yeah, and you've got inflation that's going to kick you in the pants. Besides, get a fixed rate of what, 3-4%. What's that? It just doesn't make any sense. But the bond market is much much bigger than the stock market. It's just a matter of that is the one place I wouldn't go at all. The bonds scare the hell out of me right now.
So we're staying out of the bond market completely.
Yeah, you're
So
gonna have to
okay.
find yield elsewhere for sure.
Are you? What about day trading? Are you doing any sort of day trading, doing technical analysis and reading the charts and making swing trades or anything like that? Kind of given just the direction the market's going, or how are you playing with that at all?
I don't do any day trading. I you know, there, there's I've yet to meet anybody that's made money long term day trading.
Right.
I'm not saying that it can't be done, and I'm not being negative on that. I'm just saying it's extremely difficult. Um, but I just brought on a client that he's like, I've got this play account. I like to mess with it. It's 50 grand. I don't. He's like, if it's down 25 or it's up 20, I'm like, listen, you keep it at E-Trade or wherever you want to keep it, and play with that. Day trade, use technical analysis, do all these things, whatever you want to do, and that's fun. And I have some stocks where I'll play some options. I'll do some different things, but that's my it's not my retirement money. It's not my what I call my real money.
Yeah.
It's if I really screw this up and goes to zero, I'm gonna be really pissed off for about a week, and then I'll be like, okay, it's not gonna alter anything in my life. So I think it's fun. You can learn a lot. You can win a lot. You can lose a lot. But I don't really. I've yet to meet anybody that does it on a reliable, if you just follow technical analysis, the memes are amazing on Instagram, of like the guy with 17 monitors and all these charts up everywhere that's created a negative tax loss of about 200 grand. So uh, they're like, they have all these books on technical analysis, and that you can just decide, look at charts and decide where stocks are going. And there's at least 30 to 50 technical indicators that you have to know like the back of your hand,
Okay.
because you could have 45 perfect indicators saying a stock's going up or down, and it's the one that matters that's not in that list. So it
Right.
is I don't find technical analysis to be super useful. I think it's kind of I think it's interesting. I think it's fun. I think it can be a tool, when you just look at a chart. But realistically, when I'm looking at a company, I'm listening to the conference call, I'm looking at the balance sheet, and then the most important thing I'm doing is I'm going out. Like if I this I don't know, if I was going to go buy a retailer, for example, I would go into the store and walk around. I would go in, to, like, if I was going to buy Disney, I try this. I look at my daughter watching streaming. I'd go down to Disneyland. In Anaheim, I'd see what the lines are like. I'd go,
You
so
lose all your money doing that.
yeah, you lose.
That place is expensive.
It's, I don't know how I don't know how people afford it, but
You have to take out a mortgage just to pay for gas and park, and then literally the park's like $1,000 to get in it. It's ridiculous.
Yeah, it's nuts. I don't know how an average median household income. I mean, for a lot of people I know, that's their one vacation a year, and I don't get it, but yeah, to each their own. So I like, go out and like, there was a company called Oatly, and I have some international clients that they're like, this stuff is taking off, and we got to buy it, and they're like, oh, the Oatly, it's the creamer that you put in coffee. That's at all like the new hipster coffee joints around town, and listen,
Okay.
it's good. I like it. I think it's a good product, but they when you go and you like, okay, and then you look at the valuation, it's one of those stocks that the chart on it looks like the Grand Canyon, so you're like, okay, yes, but for creamer, or
Yeah.
for just certain things that you kind of want to go out and touch and feel like, when I walk into Best Buy and I still see huge areas where they're selling DVDs, and I'm like, it's 2022. Why are they?
Yeah.
There's nothing more productive they can be doing, and so that gives me. It doesn't mean the stock's going down or up, but something like that. Like, I follow that stock. I don't own it, but I follow it, and it's done very well through the pandemic. But I look at it, I'm like, they're still selling DVDs and some CDs. I'm like, it's like, so you look at for like red flags. That's just an example of something I would,
Yeah. No, that makes sense. I mean, we're trying to get a washer and dryer from Best Buy, and it's been almost 3 weeks, and they keep delivering the dryer without the washer. I have no idea what's going on over there. Like, what are they?
Yeah.
What kind of operation are you running?
I mean, this and like, for example, the supply chain stuff is the reason the economy is very strong. And I can tell you, I just moved into the Century City office here, and thank God the camera just points this way, because the rest of the office is not done at all. Because I designed the whole thing, but it's going to be July and August before the credenza, the couch, the rug, like,
Yeah.
it's literally going to be into the next quarter before my office is even done, because I can't get anything sooner than that. So it's a matter of supply chain issue is still very much an issue, but yeah, day trading is not something I can do on a reliable. I know how to make money. I would say shorter term, but not day trading. I'd get my hat handed to me. I'm
Yeah.
just not. I'm not that guy. But
Yeah, absolutely. Okay, so one more thing before I kind of get ready to let you go here. So we were talking with David Young, who used to work with Bill Gross over there at Pimco and whatnot, and David started his own kind of company, and he's a big part of the Deferred Sales Trust. So if you want to hear his story, he was on the mastermind group a few weeks ago. So go check that out. You can find it on our YouTube channel. We've done multiple podcasts with him, so definitely go check that out. But he was talking about how the economy can carry 3 to 4 different, what he calls, inflationary rocks that you puts in the economic backpack, right? And we can kind of handle some inflation and some supply chain issues and some and some increased money supply, and maybe like a pandemic, right, or something like that. Like, okay, like the economy would be like, okay, but he's like, now we got these things going on with China and Russia, Ukraine, and we have all of these different kind of like things coming in that are really starting to weigh down the economy. And we're more at like 6 to 7 kind of inflationary rocks kind of in the backpack. So we're not going to be surprised if we see a shift here in the next, year coming into 2023. We're thinking maybe 22 will be relatively okay, but at some point the economy is going to slow down, relatively good. And then it's like, we wouldn't be surprised if we saw that in 2023. What are your thoughts on that?
I'd say that that's the consensus right now, is like 2023 recession, and good. I mean, my thoughts on that are Good. I mean, everything has a cycle. Everything
Right.
in life has a cycle. And if you look at the chart on the S&P, the Dow, the NASDAQ, the last 3 years, let alone the last 10 years, um, it would be actually more alarming to me if we didn't. And the recession has become a dirty word because of the Great Recession.
Right.
And our generation that grew up through the Great Recession, but the reality is we won't know that we're in a recession until it's over, essentially, or damn near towards the end, right? It's
Right.
just it's a few quarters of slower economic growth, and it can be much more than that. It can be elongated, but um, it would be a good thing to see things normalize. It would be a good thing uh, to see that, because if we had another 20-30% year, I feel we'd all be standing on the top of a cliff, because it would just I think the fall from grace would be catastrophic, right? And would destroy a lot of families. But to have a regular part of the economic and business cycle, regardless, I think there, like you said, he's absolutely right. There are at least 6 to 7 factors rather than the usual 4 that are going to put on top of that. But it would be a good thing because we'll get it over with,
Yeah.
and we'll normalize. I mean, I don't think we're in a bubble. I don't think any of that kind of stuff. I mean, the government, the U.S. debt is concerning for sure. That's an issue. But that doesn't mean that that's going to be an issue in 23 or 24, 25. No one knows what that future tale is. But it would be good to see a slowdown and see a choppy market like we're in now. And good. I mean, if you look at the individual names on the NASDAQ and the Dow, I mean, there is some carnage out there. So the overall averages have been held up by Apple, Microsoft, Google, companies like that are just, they are full bore ahead. They're
Right.
extremely healthy. Um, but it would be a good thing to see a slowdown, because it's a part of the cycle that nobody likes. Just like, people in LA complain about when it rains.
Yeah.
It's good for it to rain every once in a while. You can't be on this, it's like being on a roller coaster that just keeps going up and up and up and up. It might have a little dip, but just never really levels out. You never really have any of the round circles. It's part of the process. It would actually be really good, because that will set up the next leg up. You
Yeah.
know, people thought 20,000 on the Dow was crazy, 30,000 on the Dow was crazy. In our lifetimes, I would be blown away if the Dow is not at 80 to 100,000. That's
Right.
only considering that we get an annual return about 7%. So, but it would be really good to have a recession, as unpopular as an opinion that it is, to see things normalize. So
Yeah.
I'm
No,
all
definitely.
for it, although my clients are going to hate it.
Yeah, I think that's healthy, and you guys heard it here. So you don't worry. It's good. It's a good thing for it to normalize out, so we can get ready for the next bull run. So I love it. All right. Well, Matt, thank you so much again for coming back on. And guys, if you want to connect with Matt, connect with him on Instagram at Murawski.mj. That's MURAWSKI.MJ. You can connect with him there. Goodstein Wealth Management. Any parting words?
Thanks for having me back, Pearson.
Yeah.
I love good. I've been doing a lot of research on the DST, and I appreciate being on.
Yeah, absolutely, guys. And as always, we have our Deferred Sales Trust Mastermind every Friday at 10 a.m. Pacific, 1 p.m. Eastern. You can go and figure that out. Sign up for that at capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. If you're interested in learning more, we have a ton of stuff on our YouTube channel. Make sure you go check that out, Capital Gains Tax Solutions. Check us out on Facebook. Listen, rate, review, subscribe to our podcast. And thanks again, everybody, for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way to create and preserve and grow your wealth. Guys, rate, review, subscribe. Thanks again for coming on. And Matt, appreciate you, man. Have a good one.
Absolutely. You too.